Peter, great to speak with you. I spoke to you this morning on Squawk Box, so it's nice to talk to you twice in one day.
But you guys are the hardest working people on TV.
Now that we've gotten the Fed minutes, Peter, I'm wondering, what's your general reaction? Were the markets bearish after this, given the steeper inversion?
I think the minutes didn't reveal any new news, but did reinforce for markets that the Fed is flexing their muscles to try to fight inflation. And how far they are going to get inevitably with the rate hikes, we'll have to see. But at least for now, they seem to be pretty committed to get the Fed funds rate to about 3%, but probably then look around to see what the state of the economy is, see where the inflation numbers are, and then go from there. At the same time, in the background, which not many people are talking about, is quantitative tightening has only just begun, and it won't be until September before it ramps up. But in terms of the yield curve today, it definitely was just in response to, again, the reinforcement that the Fed's going to continue to raise rates on the short end, and the long end is obviously very sensitive to the reality that growth is slowing and will continue to.
So the impact of tightening overall in aggregate will actually be much harsher on the economy than just a 50 to 75 basis point hike in July, is what you're saying.
Well, and this has been going on for decades, is as time goes on and more debt is embedded in the financial system via low interest rates, we become much more sensitive to even modest changes in interest rates. So a mortgage rate that went from 3 to 5 is a rather short move, relatively speaking, but historically 5% is still a low mortgage rate, but it was enough to cause a very sharp decline in the pace of transactions. So I think, and we've seen a rise in interest rates that historically are very low, but enough to cause a 30% decline in the NASDAQ in a very short period of time and to freeze up, funding for a lot of smaller companies. So it's that modest rate of change that has a pronounced impact. And that's why this whole soft landing, hard landing debate, we have the most aggressive monetary tightening in 40 years. I don't see how you have a soft landing in that kind of environment.
And Peter, it's Tim. Is that okay? And I would just, you're talking about mortgage markets, and I would argue that the Fed's #1 job is really to get control of the housing bubble. That's the biggest bubble we have out there. I'm just curious your thoughts on that.
Well, I agree, because we need to sort of wring out these excesses. If you're a first-time home buyer, I feel really bad, because the price you're paying is not just 20% above where it was a year ago. A year ago, that was up 15% from the year before. So we do need to go through sort of this self-imposed pain in order to correct some of these excesses. The one thing that Powell only gets now, but forgot in 2020, 2021, is you need stable prices to create the foundation for a healthy economy and then maximum employment. So it is a process that we need to go through, but it's still going to be a painful one notwithstanding. But again, it's something that we need to do.
Peter, great to speak with you again. Thanks.
Thanks, Melissa.